Hey guys, I'm finally back. I just finished my final exams and I have some time to implement a new idea which our editor Rupesh has pitched, which is going to be one company analysis possibly per week, which we're going to deep dive into the history of the company, the numericals, try to figure out the things which an investor should be looking for in those companies. And we're possibly going to pick up certain companies which you guys have been asking for quite a while. So don't think that we haven't been reading your comments. We have been reading a lot of your comments, and we do plan to pick up some of the companies that you have been asking for. And there will be some companies which we ourselves are interested in, which we want to do an analysis on and share with you guys. And it's going to be a good learning experience for me and my team. And I hope it's going to be valuable to you guys, the audience. And we're going to try and put out a company analysis per week, and we'd love your feedback on it. And if you do have any suggestions, you can leave them in the comments below. Again, I thank you for your patience and your support for this series, and not only this series, but for our channels. Thank you once again.
Hi everyone, welcome back to Be Rich. Happy Sunday evening. I hope you had a wonderful weekend. I've been catching up with you, the podcast in the morning, the evening videos. So I hope you've had a good weekend. And you're ready to get back at it in the second week of Feb as we get into our Tiffin Coffee Challenge, as we plod on with day 27, I think probably it'll be. 27, I guess. Yeah, 27 it should be. Anyway, whatever date it is, I'm sure I would have announced it on Instagram that we get on investing and moving forward in our 247-day challenge, trying to be consistent in our investing and to be disciplined. No matter what the market news is tomorrow, whatever is happening, stay within our range, whatever that is comfortable for you, where risk is tolerance is manageable for you mentally. Stay invested and keep plodding along. Like I said, this is for the long haul. I'm talking about not just this year. We're going to build year on year, and hopefully 10 years from now, I don't know where YouTube will be, but Instagram will be, I have no clue. But we will definitely be in much better financial shape, all of you who are willing to join me on this journey. That said, a lot of you had asked me about bonds and debt instruments. So I did speak about this on Instagram where I spoke in Tamil as you guys requested. This is the same thing which I'm talking in English, because for those of you who didn't catch me on Instagram or not on Instagram, can find the same information here in English. And those of you who did see it on Instagram and Tamil, who couldn't understand what my poor Tamil is, can now probably decipher what I was trying to say in Tamil in English, because English is a much stronger language for me than Tamil, because I grew up with English all around me. That said, so what are bonds and debt instruments? Well, what do bonds offer? Bonds offer a steady source of income. One, right? That income could be monthly, it could be quarterly, semi-annually, or annually. This steady income could be, it has a much lower risk compared to equity because you don't lose your capital, and it has diversification away from equity. So you have debt, which is bonds, then you have equity, which is your capital market. So this is the difference. Bonds offer steady income, they lower risk, and you get diversification benefits by investing in this. What is basically a bond? Bond is nothing but you lending your money to the government or a municipality or a corporate, and they in turn give you interest payments. And at the end, when the bond is matured, they return your capital, what you gave them. So it's literally you lending your money, like how you take a personal loan. It's the same way them taking a loan from you. That's what a bond is, nothing more. There are different types of bonds. There is a government bond. In government bond, in India, you have GSECs and you have the T-bills. These are usually, you can get them issued by the government, and they offer certain returns, and you can, what you call, pick them up in the RBI directly if you want to. In the US, you have the T-bonds, T-notes, and T-bills. They're different, but they're all issued by the government, and they have different interests and risks and everything. So that you can dive into and read. I'm not going to talk about government bonds too much in this video. I just wanted to let you know government bonds are there. For those of you who are interested, you can definitely go research more about those. What I'm going to be talking about more are the corporate bonds. In corporate bonds, you lend money to companies, and this could be for expansion or operations. In India, most of the bonds are issued by financial, small financial companies or microfinance companies, because they need to raise capital for their operations. In turn, they borrow money from you, then they lend it out, collect interest like a bank, and keep the profit and they return your interest back to you. So they make a spread on that. So that's what most of the corporate bonds are. I'm not saying all of them, I said most of them. And the other type of corporate bonds in India which companies use, like Vedanta or someone might issue, are for either to close existing debt or it could be for expansion. But corporate bonds usually have higher risks, meaning it's more risky than a government bond because the government is sovereign, meaning as long as the country is there, you're going to get your money back. But in terms of corporates, it's not so. You have secured and unsecured corporate bonds. Secured bonds, no matter what, they have to pay you the money back, and those allow for less interest rate. The unsecured bonds is if something goes wrong, you also are willing to take on the risk as a business owner, and you may not get your principal back, and that will offer usually a higher interest rate compared to the secured bonds. Aside from corporate bonds, you have municipal bonds, which are the local government to raise money for infrastructure and all that. Those are also there, which I'm not going to dive into. In corporate bonds, you have something known as the convertible bonds. Convertible bonds are agreed on. It's like a hybrid version of a bond. What does it do? It offers you the benefits of a bond where you get fixed income on your capital, but instead of getting your capital back, you can opt to take shares, equity shares, at a fixed price which you have already agreed on when you buy the bond. So let's say you buy a bond from ABCD company and you say 10 years from now when it matures, instead of giving back my capital back to me, you give me so many shares at this price, agreed on price. So that way, if it's a good company, you get your interest. At the end of it, instead of getting your money back, you will get so many shares at an agreed on price. And if all goes well, the company will be trading much higher than that, and you get these shares at a discount. So you get capital appreciation too. So it's a win-win. So convertible bonds are those. Other than that, you have something known as zero coupon, inflation linked, and high yield junk bonds. That's too much information for you as a beginner. So I would say just focus on corporate bonds in India. That you have secured and unsecured. Secured bonds guarantee your return on capital. Unsecured, there is no guarantee. And unsecured, of course, will offer you higher interest rates. Now, there are some key factors in bonds you should look at, key elements which you should keep in mind when you look at bonds. One is the coupon rate. Coupon rate is the interest. Like you have an FD, you know the interest rate. Same thing is known as in bonds is called coupon rate. So that is the interest they're going to be offering you. That will tell you is it going to be monthly, quarterly, semi-annually, annually, or sometimes they give it lump at the end. The time of maturity, they put all the interest together and they give it to you. They pay it to you back like a FD. So check that out. Second is maturity period. When it comes to maturity, like FDs, it can be 3 years, 5 years, 10 years. And you have something known as perpetuity bond. Perpetuity bond is it never expires. You keep paying interest and the capital is with them. So you can sell the bond or you can exchange the bond. These perpetuity bonds are much harder to sell because they are less liquid than other bonds because the money is locked in perpetuity. But companies can do a call option on these bonds and says, you know what, we agreed to perpetuity, but our conditions have improved, or for some reason we're not going to be able to pay anymore, so here's your capital and they can return it to you. Keep it in mind. The next thing which I should keep in mind is another calculation which I'll share with you is known as yield to maturity. Yield to maturity is nothing but all the interest you receive plus the money you put into the bond added together, and that is known as the yield to maturity. That is a number which you can know. So let's say you put a 10 rupees into a bond, they'll say yield to maturity is 13 rupees. That means at the time of maturity, with all the interest put together and the capital return being back to you, would have mean 13 rupees together. So that is yield to maturity. Fourth, and the most important thing to keep in mind in bonds is credit rating. Credit rating is the most important part of bond valuations. AAA is the safest, right, in terms of bond ratings, but it offers the lowest interest. Then you have BB, CD, and all these other letters which come down the order. Naturally, the risk increases as the letters get lower. The more the risk is, of course, the interest rate will be much better. They'll be giving you more money, but of course, you'll be adding on much more risk. Meaning you may not get your capital, the company may not be able to be financially very solvent. So that is to keep in mind. If you're putting in bond, when you're putting in bond, just don't get enamored by a huge interest rate. Someone saying, I'm giving you 15%. Check the rating. See, why are they giving you so much? So keep that in mind. If someone's offering you 15% interest and it sounds really too good to be true, there's a reason for it. It's probably the credit rating of the company ain't so good. So the worse the financial situation of the company, the worse the rating of the bond will be, and more likely the higher the interest rate. So keep that in mind. In bond market, how does it move? They say something in the bond market, prices are going up and down. You're probably wondering, what is this? First of all, as a beginner and as a value investor, when I say invest in a bond, I'm hoping that you'll invest in the bond and you'll be able to hold it till maturity. That means till the bond comes to maturity, like an FD, that is 3 years, 5 years, 10 years, whenever the maturity is, you'll be willing to wait. Because if we're doing that, then this whole thing of bond market doesn't apply to you. This applies to people who want to buy and sell bonds like stocks. So some people do this. As the interest rate goes up, bond prices come down. As the interest rates come down, bond prices go up. They have an inverse relationship. So some people try to buy a bond when the interest rates are low. They try and sell the bonds as the interest rates goes up. They buy bonds. They try and ride the cycle, which you can. But the problem in India is, this works very well in the US. This is where you see there's all these Hollywood movies talking about bond market. I'm a bond trader. In India, it's not so, because the Indian market is not very liquid, meaning it's not easy to sell and buy bonds in India, because the secondary market in India, where the secondary trade happens between people who own bonds, have to be willing to buy and sell it. That's a secondary market. That market is very small in India. Why is this small? Because most investors, retail investors, are still getting used to doing equity buying and selling. They haven't gotten interested in bond markets. The retail participation in the bond secondary market is very low in India. Maybe as things improve, as more people understand about bonds, it will improve and become more liquid. But as things stand right now, it's not very liquid. It's very hard to buy and sell bonds. That's why I keep warning you about this. And the FII access to these markets are very restricted, the bond markets. This is another reason why it's not so liquid. Anyway, I hope this kind of gives you some clarity on all about bonds and how to buy bonds. Yes, there are online apps where you can buy it, like Int Money. You can definitely log on and look at bonds, GoldenFi and some Bonds India, some whole bunch of places. But I would not recommend you do this. I would recommend you get yourself a bond broker or financial advisor, someone who's knowledgeable in this, because you are not knowledgeable. And it's better to get someone's advice, so they explain to you, hey, this company is this is the bond they're offering, these are the risks. The same company can offer a risky bond, the same company can offer a very secure bond. To understand all this, it's better to have someone explain it to you. Then look at some YouTube video or Instagram reel and buy a bond. Please don't do that. That would be my strongest advice, for the simple reason, if you want to pull your money out, it's not so easy to sell the bond, like how you sell stocks. Most people don't realize this, and they just buy the bond and then they're stuck with it and they don't know what to do, because the money is required urgently and they do not know how to get rid of their 10 lakh bond. Keep that in mind. Hope you found this video informative and entertaining as always. Do like and subscribe to the channel. And tomorrow is Monday. Do invest in Tiffin coffee ranges, like I said in the beginning of the video. Have a wonderful week ahead. And I'll catch you tomorrow evening with another video, probably something more stock specific than something generic like this. Thank you again for watching me on Be Rich. Bye.
Hey guys, that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it. And we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu. And these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you.